Welcome to a new episode of Inside the Economist's Mind. In our previous few episodes, we discussed how monetary policy is transmitted in Australia and how the Reserve Bank implements it. We also explored unconventional monetary policy tools used during major crises like the GFC and COVID-19.
That's right.
Building on that, today we're going to really dig into something fundamental that underpins all of that. What actually causes inflation? It's the thing that, eats away at your savings and affects the price of pretty much everything. So understanding its drivers is key to making sense of those monetary policy tools we've been discussing.
Absolutely. And to guide our exploration, we're focusing on the Reserve Bank of Australia's document, Causes of Inflation. Think of this as the RBA's own diagnosis of why prices go up. Our goal is to break down these causes in a way that's not only clear, but also gives you, the listener, a real insight into this crucial economic concept.
So let's get right to it. First things first, what are we actually talking about when we say inflation, and how do we keep score here in Australia?
Well, in its simplest form, inflation is a sustained increase in the general level of prices for goods and services.
Right, things just get more expensive over time.
Exactly. You end up paying more for the same stuff. And the primary yardstick we use in Australia, the one the RBA watches closely for its target, is the Consumer Price Index, or CPI.
Right, the CPI tracks how the prices of a typical basket of household goods and services change. And the RBA's aim is to keep annual CPI inflation within that 2 to 3% range. Yeah.
That's the target, precisely.
Yeah.
While the CPI is the main measure, it's worth remembering that there are other ways to gauge inflation.
Okay.
But the RBA's analysis suggests that these different measures tend to follow similar trends over the longer run anyway.
Which brings us to the heart of our discussion.
Yeah.
Three main reasons the RBA points to as the causes of inflation.
Yes.
These are demand pull inflation, cost push inflation, and something a little more intangible, but just as important, inflation expectations.
Exactly. You can sort of think of it this way. Demand pull inflation comes from, well, too much demand. Cost push inflation stems from rising costs of production, the supply side.
Right.
And inflation expectations are about how what we believe about future inflation can actually influence what happens today.
Okay, let's start with demand pull. What does it really mean for demand to be strong enough to pull prices upwards?
Demand pull inflation essentially happens when the total demand for goods and services in the economy, what economists call aggregate demand, outstrips the economy's ability to produce those goods and services.
Aggregate supply or potential output?
Exactly. Aggregate supply or potential output.
So imagine everyone suddenly wants to buy the latest phone, but the factories can't make them fast enough. What happens then?
Precisely. This imbalance, where there's more demand than supply, it gives businesses the power or the scope to raise their prices.
Right, they can charge more.
And often boosting their profit margins in the process.
And what kind of things can fuel this surge in overall demand? Is it just consumers?
Oh, several factors can play a role. Consumers might start spending more. Maybe they're feeling optimistic or have extra savings.
Okay.
Businesses might increase their investments. Government spending can also rise.
Right.
And finally, an increase in net exports, meaning we're selling more overseas than we're buying, that also adds to aggregate demand.
Now, here's where it gets interesting. It's not just about everyone wanting more stuff. The RBA also highlights a crucial link to the job market.
That's right. When demand for goods and services increases, businesses generally need more workers.
Makes sense.
This higher demand for labor can lead to companies offering better wages to attract and keep employees. Now, while that's certainly good news for workers...
It also adds to the business's costs.
Exactly.
And these higher labor costs can then feed into the prices they charge.
Right.
Potentially creating a bit of a cycle.
That feedback loop is a key part of the demand pull mechanism. And as the RBA points out, wages are a pretty significant chunk of most firms' overall costs. If wages grow faster than productivity, we're not producing more output per hour for that higher pay, then the cost of producing each unit goes up.
Pushing prices up.
Puts upward pressure on prices, yeah.
The RBA also talks about potential output and when the economy is operating at full capacity. What do these terms really signify?
Think of potential output as the maximum level of goods and services the economy can sustainably produce.
Sustainably being the key word.
Yes. When all its available resources, like labor and capital, are being used efficiently without causing inflation to accelerate.
Okay.
When aggregate demand goes beyond this potential, that's when inflationary pressures really start to build.
And if it's below?
If demand is below potential, you tend to see downward pressure on prices, or at least less upward pressure.
Like the economy has some slack.
Exactly.
And to help gauge where the economy is relative to this potential, the RBA mentions the NAR, the non-accelerating inflation rate of unemployment.
Yeah,
That's a bit of an economic tongue twister.
it is. But the underlying idea is quite useful. The NARU is essentially the lowest unemployment rate an economy can handle without inflation starting to rise.
Kind of like a speed limit for unemployment.
Yeah, that's a good way to put it, a natural speed limit. If you push unemployment too far below the NARU, the economic engine starts to overheat, inflation tends to rise.
And above it.
If unemployment is above the NARU, there's usually downward pressure on inflation. It's an indicator of how tight the labor market is.
And the RBA provides some visuals here in the document. One graph illustrates how the output gap, the difference between actual production and potential, and the unemployment rate gap relate to inflation over time. You can really see that connection.
Exactly. You can see periods where a positive output gap lines up with rising inflation, and the other graph just shows the basic idea of demand pull. AD shifts right, pushing up both price levels and output.
Okay, so that's the demand side covered. Now let's turn our attention to cost push inflation. This sounds like the pressure on prices is coming from the supply side.
Precisely. Cost push inflation occurs when the total supply of goods and services in the economy aggregate supply decreases. And this often happens because the costs of producing those goods and services have gone up.
So what kind of cost increases are we talking about here? What pushes them up?
Several things. Higher prices for raw materials like oil or metals is a big one.
Domestic or imported?
Yeah, domestic or imported inputs. Even the cost of components that businesses buy from other firms can increase. If these input costs rise, it just becomes more expensive for businesses to produce the same amount.
And how does that then lead to higher prices for us as consumers? Do they just pass it on?
Well, when businesses face these higher production costs, they often respond by producing less because it's less profitable at the old price and raising the prices of their goods and services.
Trying to protect their profit margins.
Right. This increase in prices due to rising costs is the essence of cost push inflation. And as the RBA highlights, these cost increases in one sector can have ripple effects throughout the economy.
Can you give us an example of those ripple effects?
A classic one is an increase in the price of oil.
Yeah.
Not only does that directly mean higher prices at the petrol pump, but oil is a key input for so many things. It increases transportation costs,
Which hits almost everything eventually.
Exactly. It gets passed on in the prices of everything from groceries to manufactured goods that need to be shipped.
Right. It's like a chain reaction of higher costs.
Yeah.
And the RBA also mentions that unexpected disruptions to supply, like natural disasters, can lead to cost push inflation.
Yes, absolutely. Unusual weather events like cyclones and floods can severely damage agricultural production.
We see that with fruit and veg prices sometimes.
Definitely. When that happens, the supply falls, which can lead to temporary but often significant increases in food prices. And that affects not just fresh produce, but also processed foods, restaurant meals.
And we have another helpful graph here illustrating cost push. In this case, the aggregate supply curve shifts left.
That's right, indicating a reduction in supply. And the result is a higher overall price level, but importantly, a lower level of total output.
So unlike demand pull, where output might rise with prices.
With cost push, you often get rising prices and potentially lower economic activity. It's a tougher combination.
Now, the RBA also specifically discusses imported inflation and how the exchange rate plays a role. How does the value of the Aussie dollar affect the prices we pay?
Okay, so a depreciation of the Australian dollar, basically, a fall in its value compared to other currencies, can lead to higher inflation in a couple of ways.
Okay, what's the first way?
Firstly, it directly increases the cost of goods and services that we import.
Right.
When our dollar is weaker, it takes more Aussie dollars to buy the same amount of foreign currency, making those imported items more expensive for importers and usually for us.
So that's the cost push channel again.
Exactly. It directly contributes through that cost push channel. Think imported cars, electronics, clothing.
So if a shop buys furniture from overseas and the Aussie dollar drops, they have to pay more and they'll likely increase the price they charge us.
Precisely. And secondly, a weaker dollar can also boost overall demand in the economy.
How does that work?
Well, our exports become relatively cheaper for people in other countries to buy.
Ah, so they buy more of our stuff.
Demand for our exports tends to go up, yeah. At the same time, because imports are more expensive for us, Australian consumers and businesses might switch to buying more domestically produced goods and services instead.
I see. Shifting demand towards local products.
Right. This increased demand for domestic products can put pressure on our production capacity and give local firms more leeway to raise their prices.
So that's contributing through the demand pull channel.
Exactly. So a weaker dollar can hit us with higher import costs and increased demand for local goods. A double whammy, potentially.
And the RBA points out that this effect is more pronounced for tradable goods, right?
That's right. Tradable goods and services, things that can be easily bought and sold across borders, are much more sensitive to exchange rate changes.
Makes sense.
The prices of non-tradable goods and services, things like getting a haircut or local council rates, tend to be influenced more by what's happening right here in the domestic economy.
All right, we've covered demand pull and cost push. Now for the third key factor, inflation expectations. This feels a bit less tangible. How can what we think about future prices actually cause inflation today?
Yeah, it does seem less concrete, but it's incredibly important. Inflation expectations are essentially what households and businesses believe will happen to prices in the future.
Okay.
And these expectations are really influential because they can shape current economic decisions made today, which in turn affect the actual rate of inflation.
So give me an example. If a business owner thinks their costs are going to rise significantly next year, what might they do now?
They might decide to increase their prices more now in anticipation of those future cost increases rather than wait.
Okay, preemptively.
Yeah. Similarly, if workers expect that inflation will be high and eat into their wages.
They'll ask for a bigger pay rise now.
Exactly. They might demand larger wage increases in their current negotiations to protect their future purchasing power. These actions, driven by expectations, can actually lead to higher actual inflation.
So it becomes self-fulfilling.
It can, yeah. This is often referred to as inflation psychology or self-fulfilling prophecies.
So it's like if everyone expects prices to go up, their actions cause prices to go up.
That's the core idea. And this brings us to the important distinction the RBA makes between anchored and unanchored inflation expectations.
Anchored versus unanchored. What's the difference?
Okay, so if people and businesses generally believe that inflation will eventually return to the central bank's target range, that 2 to 3% here, regardless of what's happening right now.
Even if there's a temporary spike.
Yeah, even if there's a temporary spike due to, say, an oil price shock, if they believe it'll settle back down, their expectations are said to be anchored.
Like an anchor holding a ship steady despite the waves.
Good analogy. And the benefit is huge. When expectations are well anchored, a temporary burst of inflation is less likely to become persistent.
Why is that?
Because people and businesses expect things to return to normal, so they don't drastically change their behavior, like demanding massive wage rises or hiking prices excessively in ways that would embed that higher inflation.
Okay, that sounds like the ideal situation for the RBA. What happens when expectations become unanchored?
That's the danger zone. If inflation expectations become unanchored, it means people and businesses start to believe that higher inflation is the new normal, that it's here to stay.
They lose faith in the target.
Essentially, yes. They adjust their behavior accordingly, expecting higher inflation long term. Businesses might keep raising prices aggressively. Workers keep demanding higher wages just to keep up.
Leading to a wage price spiral, potentially.
It can contribute to that, yes.
Yeah.
And it leads to a much more persistent and problematic period of high inflation. The anchor's been lost, and the ship is drifting.
That sounds like a nightmare for the RBA to manage.
It absolutely is. When expectations are unanchored, it's much, much harder for a central bank to bring inflation back down to target.
Why? Because they're fighting beliefs as well as prices.
Exactly. They're not just addressing current price pressures, they're trying to change deeply held beliefs about the future, which is a much tougher job and often requires more forceful policy action.
How do policymakers even figure out what people expect inflation to be? You can't just read minds.
No, you can't. That's a good point. Inflation expectations aren't directly observable, so the RBA and other central banks use a variety of methods.
Like what?
They conduct surveys asking households and businesses directly about their inflation outlook.
Okay.
And they also look very closely at signals from financial markets. Things like the difference in yields between regular government bonds and inflation-indexed bonds can give clues about investors' inflation expectations.
Interesting. Now, there's a section in the RBA document, a box, that talks specifically about supply shocks and stagflation. That sounds particularly nasty.
It really is. Stagflation is a horrible combination. It's characterized by slow or even negative economic growth, the stag part for stagnation, alongside high or rising inflation.
And often high unemployment, too.
Often high unemployment as well, yeah. It's a really challenging mix.
How do those supply shocks we talked about earlier, the cost push ones, contribute to stagflation?
Well, large and persistent supply shocks are often the trigger. They don't just cause cost-push inflation by driving up input costs.
Like oil prices again.
Right. But they can also significantly reduce both the economy's current and potential output. If a major input becomes scarce and expensive, or if disasters wipe out production capacity, the whole economy can produce less.
So you've got less being produced, output falling or stagnant, and what is being produced is getting more expensive. Erg.
It's not a good place to be. And as the RBA emphasizes, if inflation expectations become unanchored during a period like this,
It makes it even worse.
much worse. It can entrench the stagflation, creating a really damaging cycle of rising prices and weak growth that's hard to break out of.
The RBA uses the oil price shocks of the 1970s as a classic historical example. Can you remind us what happened there?
Sure. The 1970s saw two massive oil price shocks. The first, in '73, involved the OPEC oil embargo.
Right.
Oil prices basically quadrupled almost overnight. It caused energy shortages, rationing in some places.
And the economic fallout.
It significantly contributed to a global recession. Crucially, both unemployment and inflation surged across many developed countries. Then there was another major shock later in the decade.
And the result was that prolonged stagflation.
Exactly. A long period of high inflation combined with sluggish economic growth. And it's worth remembering, as the RBA notes, that back then, central banks generally didn't have the explicit inflation targets they do today.
Which probably didn't help anchor expectations.
Precisely. That lack of a clear anchor likely contributed to inflation staying high for so long.
It's really fascinating and a bit sobering to see how these different causes, demand, costs, expectations, can interact and create such complex challenges.
Yeah.
And it really brings our previous discussions about monetary policy full circle, doesn't it?
It really does. Understanding these underlying drivers, what's actually pushing prices up, is absolutely crucial for understanding why the RBA adjusts interest rates or uses those other tools we've talked about.
Their policy decisions are aimed squarely at influencing these causes.
Exactly. Whether it's trying to cool down excessive demand with higher rates or trying to keep inflation expectations anchored during a supply shock, it all comes back to these fundamental drivers.
So, to sum up this deep dive, we've looked at the RBA's view on the main causes of inflation. Demand pull, where strong spending pulls prices higher.
Yep. Too much demand chasing too little supply.
Cost push, where rising production costs squeeze supply and push prices up from the production side.
Things like oil, wages outpacing productivity, supply chain issues.
And finally, inflation expectations, where our beliefs about future inflation can actually shape inflation today.
The psychological, self-fulfilling element.
It's vital to remember that these factors don't operate in isolation, do they?
Not at all. They are deeply interconnected and influence each other constantly. A demand surge might fuel inflation, which then shifts expectations, leading to bigger wage demands, feeding back into costs. It's complex.
Yeah, or a supply shock drives up costs, but also hits confidence and demand, and maybe affects expectations too.
Exactly. It's a dynamic interplay.
Okay, so considering these different causes and how they can interact, perhaps something for you, our listener, to think about is this. What do you think is the biggest challenge for central banks in keeping inflation within that target range in today's global economic environment? Is it managing demand, dealing with unpredictable supply shocks, or keeping those tricky inflation expectations anchored?